Good afternoon and welcome everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. As many of you are aware, the SBIA is the advocacy association for investment professionals focused on America's lower middle market companies. Our association has played a pivotal role in promoting the growth and vitality of this industry and the small businesses it supports for more than 60 years. We're pleased to bring you our Lunch and Learn webinar series with today's topic, Investor Transparency as a Differentiator, Managing LP Relationships in Uncertain Times. This is our second in a series of educational webinars designed to provide useful educational content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. Just a housekeeping detail before we get started. If you do have questions for our speaker, please email them to info@sbia.org. That's info@sbia.org. Today's session is possible due to the support of our longtime sponsor, PEF Services, and we are delighted to be joined by the firm's CEO and President, Ann Anquillare. One of PEF's co-founders, Ann has been active in the private equity industry since 1993 and currently serves on industry task forces for NCREIF, PREA, and the CFA Institute. Thank you, Ann, and now I will turn the virtual podium over to you.
Great, thank you, Mary Brown. So again, happy to be here. I've been active in the industry for a while, so no old jokes. And a little introduction on PEF Services. We are a third-party fund administrator. We support over 100 general partners, well over 250 funds, and we provide services and reporting to thousands of investors on behalf of our clients. So that is why this topic, investor transparency, is so near and dear to our hearts. For today, we are going to touch on how you can build your investor base, both current and future, by focusing on investor transparency in capital activity, reporting, and valuations. So just a few slides on who PEF is and what we do. But if after this session, if any of you have questions about the third-party fund administration, the use of a third-party fund administrator or PEF specifically, feel free to reach out to me. So again, we've been in business well over 18 years, focusing on GPs and their LPs. Our clients range across the country and our investors are global. Not our investors, your investors that we service. For those of you not familiar with the services typically provided by a third-party fund administration firm, it starts with the books and records. That everything else is built on that. That is the foundation, and you have to have a strong foundation. We provide reporting for investors as well as processing all the capital activity. We assist with compliance for the funds as well as providing an investor services team to support our clients' investors. Not going to spend a lot of time on this, but I did want to share PEF's tech stack. Technology is critical to being able to scale a back office efficiently. It's a combination of third-party applications as well as proprietary applications. The key here is that they are integrated and they support both current and future needs of the GPs and their investors so that we can grow with our clients. So without further ado, let's dive into investor transparency. So let's be honest with each other. We've been talking about this for a long time now. We hear all the time about how private capital funds tend to lag other asset classes with regards to investor reporting and transparency, especially the smaller ones. And by smaller, they're talking about firms with assets under management of 5 billion or less. So that covers a lot of ground. We are also hearing about the increase in capital and types of investors. As of June of this year, 401k plans can now offer investments in private equity funds as part of their offering plans. There's also a lot more data flowing through private equity firms. However, it's not quite getting out to their investors yet. And this is really what we need to address as an industry, especially the smaller, 5 billion and under in assets. Because if we don't address it, another thing that we've been hearing is about the consolidation of the capital in the industry, and we're becoming an industry of have and have-nots. That can't happen. If that happens, we will not have a next generation of private equity to grow over the next 10 years, and that would be very detrimental for our industry. We are a very disruptive, organic industry. We need the next generation to be coming up. So that's what we're going to really focus on today, is how our industry can tackle this, including the smaller ones. So what is taking us so long? Why are we still talking about it and no changes have really happened? Well, we're complicated. It is a complicated industry. Our investors are very diverse. They range from really super sophisticated institutional investors all the way down to the, high net worth that met a guy on a golf course and decided to invest in his fund. So it's a very diverse investor base. And standards have really been a struggle for us, mostly because of adoption, because honestly, we've been getting by okay as is. Capital has been coming in, we haven't had to adopt. But without those standards and adoption, we're also not the best place for technology investment, fintech. We should be, but we're not, because, technology needs a standard so that they can build to, and that would really help us with regards to adoption and scalability. So if our asset class, the liquid alternative asset class, is going to become the major asset class that everyone is predicting, we really need to have a few things fall into place, and that some of those are the standards, the adoption, and then the scalable solutions. And why now? What has changed? Why now? We're really at a crossroads. I mean, let's face it, this first half of 2020, by the way, I hope all of you and yours are safe and sound and everything's going okay. I mean, it's been intense. So investor confidence is really shaken. We know that valuations are taking a hit, not as bad as some would have thought back in March, but still a hit. And, everyone is really focused on the back office. What is going on with regards to reporting, and what kind of data can investors get to? Because there's been a trend over the last 4 years that investors have wanted more data faster, so more sooner, but they weren't necessarily in a position to really push for it. Now they're in a position to really push for it, and they desperately need it to do their own jobs, given everything that's going on. The other thing that's really critical is in your next fundraise, which may be 5 years from now, but you've got to start thinking about it now. What you do in 2020 will be heavily scrutinized. How you enhanced reporting, how you did your valuations. You are going to be judged by your actions of 2020. So it's really a crossroad for our entire industry right now. We're somewhat fortunate. There's been some very useful and timely developments. Portal technology today is light years ahead of where it was 4 years ago. Certainly a lot better than when we were in our last crisis with the great financial crisis. And we also can leverage universal reporting standards. The CFA Institute recently came out with GIPS 2020. It has truly been focused on addressing the specific needs of private equity, private debt, private equity real estate. I mean, they've done tremendous work in truly tailoring it to our industry, because most of the time, GIPS, it was easy to say, it's not really relevant. It's not really tailored to our operations. Now it is. That excuse is gone. So we can really leverage that as an industry. Another great industry standard bearer is ILPA. Thank you to ILPA. who recently came out with the subline disclosures. SBIA has done great work with them too in coordinating efforts in getting the information out. I mean, now is the time we really need these institutional industry standard bearers. Another great group is NCREIF PRIA. They rolled out TIGR, or Total Global Expense Ratio. That has been really helpful for the real estate industry. So the combination of the technology is now available, the standards are now available, the need is more present. You know, we're really at a crossroads that we can make this change. So what do we do? You know, at the end of the day, it all comes down to communication. It has to increase, and it has to be more organized. I mean, you can overwhelm people with data, but if it's not organized, they really can't take advantage of it, and it's not helpful. And in the past, our industry was more old school, was a lot of FaceTime, not an option right now. Anybody in the fundraising market knows that. So, you know, what are some of the things that we need to adapt to? And then how are those adaptations going to really help us as our investor base expands, both in the types and getting into retail, as well as internationally? So we're going to take a deeper dive into each of these areas that we talked about, the capital, the reporting and valuations. And then there's also some notes on here about other helpful ways, other helpful things that you can do. Like, for instance, if you are in the fundraising process, and we'll touch on this a little bit, you know, make sure you're communicating to existing investors, you know, what's going on, make sure that they see the momentum. Staying in front of prospective investors, even if you're not in fundraising right now, is crucial. You know, giving them an access to a portion of your portal, including them in some of your communications, any way to stay in front of them. Certainly making sure that you're communicating, preferably on a quarterly basis, your performance metrics. Let investors know what you're doing and how you're doing. Those are call them the PI multiples, that's distribution to paid in, residual value to paid in, and total value to paid in, as well as the IRR. They are two sides of the same coin. You need both sides. And then we're going to touch on really communicating funded and unfunded balances to your investors. You know, they need to know what their unfunded balance is at any point in time. So let's dive into capital activity. So hopefully what I'm talking about here is going to be relatively low-hanging fruit for most of you. You're doing this already in some form or shape, and that is developing projections of your capital needs over the next 90 days. So you're proactively deciding, okay, when are you clearing down your sublines? When are you drawing your sublines? You're working with the deal side of the house to make sure that they are giving you projections of any needs of existing portfolio companies, and then certainly any deal activity coming up. You know, you should also be taking the pulse of your investor base. You know, have there been any reach outs with regards to you guys thinking about doing a secondary? Or, you know, is there any concerns with regards to investor liquidity? Because you want to find that out sooner rather than later. The time to find out that an investor is having a liquidity problem is not during a 10-day window of a capital call. That's very stressful. You also really want to provide these rolling 90-day projections to your investors so they can balance their liquid and illiquid assets so that they have a reasonable time to plan for their capital call. Now, investors understand that these are just projections, you know, and they can change. But it's a matter of communicating it out to them. Just like you're doing your planning, they need to do their planning. So this would be a great step forward for our industry if the majority of us could communicate these capital activity projections. This is a great example of how you can communicate capital activity in an organized format for your investors by leveraging technology. This way you can efficiently provide the information in a way that it's standard so that investors can consistently use this data over and over in their own reports. So this is just an example of funded, unfunded. And it's especially important if your fund has recallable distributions. This has been confusing in the past for both GPs and LPs, to be honest with you. So you really want to be able to provide the source data and provide it in a real-time manner to your investors so that they constantly can see what their unfunded commitment is. There's no surprises. That's the key. We're trying to do a policy of no surprises. So we did ask for questions in advance. We only got one question, but it's a good one. So what do I do if an investor doesn't pay a capital call on time? So the first thing you want to do is reach out to that investor, because you need to find out is it that they just didn't receive the call notice, or are they having liquidity issues? You need to find the severity of the issue. Most portals do have a function that you can see if an investor or a contact for that investor has downloaded the document. But even if you saw that it was downloaded, you want to get in touch with them, because again, you got to figure out the severity of the situation. You got to find out, is it just a question of logistics? They're out of the office, they're trying to figure out how to move money around with their bank, or is this more a liquidity issue? Logistics, those are easy. You just figure it out and you plan accordingly. Liquidity issues get tricky. You got to check your partnership agreement. You got to check your side letters. A lot of side letters and some partnership agreements now have notice requirements for defaulting partners, and that default, usually is triggered by the number of days an investor is late. You also want to start considering, depending on the type of investor, the size of their commitment, where the fund is in its life cycle, if you want to pursue offering to that investor a buyout at a discount. For a newer fund that maybe was oversubscribed, this might be a relatively easy out for that investor. They probably don't have a lot of paid in capital in the investment. It's not a one size fits all. You really got to drill down into it, but make sure you review your partnership agreement and side letters. And also make sure you document everything. This is something that is going to be scrutinized by your auditors as well as regulators, and then potentially, future fundraise questions, especially if it's a significant investor. So touching on reporting standards. Again, we've been fortunate. Our industry has made great progress since the last crisis back in 2008 with regards to standards, and you can leverage those standards to efficiently add data to your investor reporting package that's not already there. This does get a little tricky when you have a mix of investors. Remember, we talked about the diversity within our investor base. For institutional investors, they really need to address issues at scale. They are looking to identify quickly what funds and what portfolio companies need additional review. Whereas the high net worth or the wealth managers, it's a bit more of a customized approach. They're looking to have confidence in the fund manager and the ability to manage the crisis. Although I will tell you that what's interesting, another trend that's going on in our industry is more and more high net worth investors are holding their interests in the private equity funds through a wealth manager. And that wealth manager does have a fiduciary responsibility to monitor those investments. So we're starting to see more and more analysis being done through the wealth management arm on behalf of the high net worth investors. So that's definitely something to keep in mind as you're growing or developing your investor reporting package. More and more investors are going to start expecting institutional quality reporting to them. With regards to the portfolio company level, ILPA put out a nice metrics template. I would say, it's a lot. You don't have to put everything in place, but the key items have to do with liquidity at the portfolio company level. Investors want to see cash, lines available, burn rate, interest rate coverage, Certainly any guarantees or commitments that the fund has to that portfolio company, it is in the footnotes, but it's nice to call that information out to the investors. They certainly want to see information on the performance of the investment in that portfolio company. What drives this is a little bit, is it a debt investment, or is it an equity investment, or is it a property or something else? We're getting very creative in our industry. For debt investments, obviously they're looking at performance. Is the interest and principal current? Have the covenants been waived? You know, and then to the extent it's an equity, you know, what is the performance on that? Especially if it was in a known process, meaning you've already communicated the fact that this company might have engaged a banker and was going into a process. What's the status of that process? What's the plan for that process? On the valuation front, to the extent that you want to leverage your existing processes and just decide what you can add and open up to the investors. Again, a tremendous amount of data is being held by private equity firms. We've just got to get better at opening it up to investors. You also do want to communicate the method of valuation, if there's been any significant changes to that method for that particular company and why. And the footnote disclosures are very helpful in this. Again, it could be the first few quarters that anybody reads them, but that's what they're there for. They provide tremendous information in a standard format, so investors can really leverage those. We're starting to see more and more often quarterly footnotes, not just annual at the audit. Also, investors are very interested in hearing about what is the date of the most recent financial information that you've gathered from that portfolio company. Is it getting stale? And then to the extent that you have collateral for your security, what's the value of that collateral? On fund level, the investors are very interested in your deal pipeline. And again, to the extent you can include this in a cover letter or in an investor call, it doesn't have to wait for the quarterly package, but definitely include it in that quarterly package. What steps the firm is taking to adjust to remote sourcing, remote diligence. Exposure charts are a tremendous tool. We're going to touch on them next. These are the pie charts that are, what's your exposure by industry, by region. And performance metrics, we talked about that. They might be ugly, but again, get into the habit of including them in your quarterly package. That way, two things. One is commitment to transparency. The second is, to the extent that your investors are calculating something differently, let's flesh that out. We got to all be on the same page. PCAPs are really helpful in communicating information as well, because if you're doing quarter to date, year to date, inception to date, the investors will be able to see the unwinding of any unrealized carry allocations to the extent that the valuations have dipped. Co-investments, that's a little trickier. Obviously, all the information we talked about in the portfolio company would be helpful to any co-investors that you have in that company, but they might need additional information because they really have to do a valuation process on their side as well. So like we talked about, this is a great example of information and drill downs that's very valuable to investors. You might not be able to provide all this detail in Q2, but work towards getting to this spot for Q3 or Q4. And this is how you demonstrate that commitment to transparency. And it's also how you build confidence and trust, because your investors are using this information to determine a lot of things. One is that you're doing your job. So exposure charts help investors analyze risk at a macro level. This is something that all institutional investors are doing. Again, they're taking a high level view and then determining where they need to drill down with regards to funds or portfolio companies. Exposure charts are typically fair market value by industry and region, and they allow an investor to determine, a hard hit industry or hard hit region. It also allows them to review trends. They will compare these the charts and the data from quarter to quarter to quarter. For example, if an institutional investor will review 3/4 of exposure data grouped by industry. So if a firm has exposure to NAICS industry 211, which is oil and gas extraction, and they are showing a 30% decline from fourth quarter last year to first quarter this year, that investor then will compare it to industry reports that they're receiving on that industry, and they'll make that determination, is that a reasonable decline across an industry? If it is, great, they can move on. If it's not, they take a deeper dive into the individual portfolio companies within that industry slice and see maybe there was an outlier, maybe something else was going on. So it just allows them to start drilling down where they need to put their resources. And then the other factor that's really important in presenting it in an organized and consolidated way is that for your investor to actually get to this information without you providing it in this kind of format, they would have to sit there and scrape the information off of individual schedule of investments across all the funds that they invest in at your firm, which is very difficult. So they are using, in some cases, data consolidators, but at the end of the day, they really would like the information coming from you. So the key is consistent format and access to the underlying data quarter to quarter, and that allows them to really have a more intelligent conversation with you as opposed to just asking you for data and then going off and trying to do their own combinations. Something I want to point out, and you'll get this when we send out the slides, is we have a nice white paper on this as well. I want to touch on subscription lines of credit. So just this June, ILPA released additional recommendations on this. It's another standard that you can leverage to add information to your reporting package. To the extent this subline is, and when I say subline, I know there's a lot of different terms for this, but sublines meaning the underlying collateral is the unfunded commitment of your investors, okay? So it does change the risk return profile for that investor. To the extent these sublines are longer in term, there's additional disclosures. If you clear these sublines out, before 120 days consistently, you don't have to do these additional disclosures. The key information, first and foremost, the net IRR of the fund with and without the activity of the subline. This way, investors can compare apple to apples by taking out the use of sublines from firms that use them and comparing them to firms that don't. The other key piece of information that you should be providing to your investors, their pro rata share of the outstanding line in both dollars and percentage. In a way, if you think about it, they have their PCAP, but if they don't know this number, they don't know how much they're on the hook for additional, once you clear out that subline. So they really should be adding this in as if it was capital that was called. They need to know that information. There is additional information in the paper, a link is below, that is recommended with regards to information about the facility, each drawdown, interest and fees paid, as well as the use of proceeds. ILPA and GIPS 2020 both has really great information on this point. So some great questions came in on reporting. Thank you very much, registrants. I love the first one. Many of my investors have 6/30 year ends. What changes might we expect through the crisis? So 6/30 year ends for institutional investors are key. And one of the key features in our industry is the use of what's called practical expedience concept. It allows for your institutional investors to use their PCAP value as their fair value for their holdings in your fund. There's a big caveat though. They can't use that practical expedient concept unless they and their auditor are confident that you have fair valued all of your assets and liabilities in the underlying fund such that their slice of the balance sheet, basically their PCAP, is at fair value. So you can see the problem. If there's a lack of confidence in the valuation, then there's a lack of confidence in the PCAP value to be used as the fair value in their audit. investors do some 2020 hindsight testing on this. They will use those exposure charts again to kind of benchmark it to what they're getting with regards to industry reports, just to make sure that your valuations are reasonable and directionally correct to their industry reports. They will also use 2020 hindsights to the extent you have a realization, and they'll go back and make sure that the valuations were in line with that realization over the past few quarters. This is how they kind of test to make sure that they can use that practical expediency. And then the other thing that's probably going to change for this audit cycle for institutional investors is the comp firms. Over the past few years, we've definitely seen these audit comp firms expand. I think last 6/30, fighting with my scarf, the big four, they were up to around 5+ pages in their comp firms. The next tier is probably around 3 to 4 pages. So it might be a good idea for you to reach out to your institutional investors, especially if they're using a big four auditor that they've used last year, and see if they can give you any heads up about additional data points that are going to be required for the audit comp firms. What about ESG reporting? Oh, sorry. How do we respond to requests from investors? Many things in yeah, I mean, that's just going to happen. Everyone's looking for data, more data, faster data. So what we're seeing most of our clients do, most in the industry do, is responding to those to the best you can, and then trying to see if there's a trend, and then adding that information into the quarterly reporting package. So if you see a commonly asked question, try to wrap it into your quarterly reporting package. That serves two purposes. One, then maybe you don't have to get the one-off questions. And two, it makes sure that there's consistency in the information going out to all investors, and you're just not over, serving one investor group and not the other, because the regulators get a little concerned about that. ESG reporting. Unfortunately, we do not have any clear standards really in that regard. There's not even clear understandings about when a milestone is achieved or what's a policy versus an action. That being said, culture is king, and culture depends on social and governance actions, not policies. It also distinguishes the companies that survive and thrive in a crisis versus those that don't. So to the extent that you are getting any information or hearing from your portfolio companies about their actions with regards to social and governance issues, put it in the cover letter, share it with your investors. That's great information to get out there. Environmental, or E, that's even more challenging. That really differs by industry, and it's tricky, and there's still a lot of work as an industry for us to do before we can have a scalable way of being able to report that to investors. Last question, I do a lot of bespoke reporting for some investors. Is that a problem? Again, this gets back to the really try to wrap it into your quarterly package, so that way you're giving the same kind of information out to all your investors, and you're not treating some better than others. That's something that you should try to be doing over the next few quarters. Okay, I'm up to valuations. I have to take a drink of water. I tell you, I have more respect for professors trying to do this all by myself. So we have done the same poll for a few different times, which is asking, what changes do you expect to see or have you seen from 12/31/19 PCAPs or NAVs to 3/31/20 PCAPs or NAVs? And we asked the question, well, Duff and Phelps asked the question on 3/31, and that was, remember, if you can recall, that was in the depth of despair with regards to the public markets. We asked it with FEA April 13th, and we asked it again with ACA on April 23rd. And then we asked it with ILPA on June 3rd, and that's when they had already received the majority of their Q1 reports. So as you can see, the light green is the earliest. So it was very heavy in the more dire predictions. And then over time, basically it shifted kind of from this decrease of 11% to more than 20% to more in the range of a decrease between 6 and 15%. So this is what the bulk of what we saw coming in with regards to the change from the end of last year to Q1. We'll see what happens for Q2. So let's just go through kind of valuation basics. It's not a fire sale, okay? But you do have to take into account current market conditions. So everybody who is doing their March 31st valuation, when the public markets and the public comps were at the lowest of the low, you have to take that into consideration. And if your comp peer group was down 20%, but you didn't think that your portfolio company should be down 20%, you really have to document that and have evidence in your documentation as to why that's not the case. The key is also that your process has to stay the same, or should stay the same, should be robust enough to stay the same, good times or bad. You need multiple approaches. You know, it's funny. In general, people love comps in good times and discounted cash flow in bad times, but you need to make sure that, you know, it's robust enough that it's incorporating both sides, both market and income approaches, so that you're incorporating as much data as possible. You know, you can use it when you're doing the market comp analysis. You should use your comp base, but to the extent that there's a real outlier in your comp base, maybe you can consider excluding it and then documenting why. For your DCF, you know, the residual value 4 years from now maybe hasn't changed so much, but I guarantee you your discount rate should have been changing. Even though the risk-free rate is dropping, you know, the risk premium is definitely increasing. So you got to take a hard look at that. And then also there's the specific portfolio attributes that we talked about in the other slide. What is their liquidity? What is their leverage? What's happening to their revenue pipeline? So again, the key is to focus on what is known and knowable as of the valuation date. You know, there are some small exceptions for subsequent events, things like a sale of the portfolio company or a sale of a comp within the time between the valuation date and the report issue date, but they're very few and far between exceptions. You really got to stick with what's known and knowable at the time of the valuation date. The other thing I really got to draw your attention to is the problem of the double dip, okay? So what happens with regards to the comps is the public markets adjust quickly to the forecasted changes for future performance. So your comps are going to have the impact of the change of the expectations of future performance in them. And then to the extent that you apply it to a forward 12-month metric of your portfolio company, you're actually double counting the change in the future expected performance. IPEF put out a really great guidance paper on this because this is something that our industry struggled with in the last crisis. So I really encourage everyone to read that paper and make sure you're not doing an unintentional double dip. And then there's a growing practice within our whole industry, definitely with regards to third-party valuations. This is something that's definitely building in pressure and emphasis from investors. So like everything else, everyone's going to be, you know, 5 years from now, everyone's going to be asking you how you did your June value. So really take a hard look at your process, take a hard look at your documents, make sure everything's in place and that you can stand by them several years from now when investors take a hard look at how you handled the crisis. So another really important part of your quarterly and annual reporting package is the PCAPs. We touched on this a little bit given the last set of questions with regards to the institutional investors that have the 6/30 year end. Again, the challenging thing is this crisis hit us in the winter, spring, and ongoing, whereas the previous crisis was more of a fall event. So, you know, stay in touch with those investors that have audits, Make sure you get the information about the audit confirmed to the extent that there's any new information needed. You know, there's probably going to be more questions with regards to your valuation process and fund liquidity. And then, let's see, did I have any other? We kind of touched on most of this in the question on the practical expediency. So certainly if anyone has any questions on this point, you can always email the email address that Mary Brown said, and I'll do my best to answer them. If not on this, then after it. So let's talk about how you can incorporate this in your quarterly package with regards to information about the valuations themselves. So you're already actually giving a lot of information in the financials, especially if you're doing footnotes. Again, we're seeing footnotes more commonly included in the quarters, not just during the audit financials. We're going to show you an example of some great information that's provided to your investors, and you might want to call their attention to it. Another thing we want to touch on is, you know, consider quarterly investor calls. You know, this is very common in other asset classes. Certainly all the publics use quarterly investor updates. That's something that we might want to consider as an industry to really, you know, start incorporating on a regular basis. And our industry has really, I mean, I don't want to be such a downer. Our industry has actually improved dramatically since the last crisis. ILPA did a poll in May, and of the GPs that they polled, 60% said that they were providing more frequent and detailed information about the portfolio to their investors. The downside, this is why I say be careful what you wish for. The downside is almost that same percentage of LPs are saying it's inconsistent, so they don't really know how to use it. So we're getting better. We just might have to get more organized. Another data point I wanted to draw to your attention is last year EY did a survey, and they do it every year, and they track what are the top 3 priorities for GPs. And enhanced investor reporting was in the top 3 priorities only for 11% of the GPs surveyed in 2018, but that increased to 24% for 19, and we're expecting an even bigger jump for 2020. So we are getting better. It's just a matter of how do we continue that trend, especially given the crisis. So as threatened, giving you some, you know, footnote examples. So again, you're already providing a tremendous amount of information to the investors. Sometimes you just need to call their attention to it. And the key is to help them understand it, so that way you can have a better dialogue, as opposed to them just asking for information. Proactively give it to them, and then you can have a conversation about it. What does it mean? What do they think it means? Are you on the same page? So as you can see, this is just a thank you to Witham for providing this. They do it every year. This is just basic information that's provided via the footnotes on your valuation process. And you can see the amount that's being valued, the income approach, the market approach, the weight ascribed to each of these approaches. So to the extent you're getting into a situation where, you know, when the market's really, really hot, sometimes private equity brings the weighting of the market approach down, because you don't necessarily want to mark all your companies to that, because you're not selling into, you know, the high of the market. Same thing holds true on the low. You know, again, you've got to be careful and thoughtful about the weighting of the approaches. And again, make sure that it's disclosed to the investors. This is just a really easy way to leverage an existing standard in disclosing that information to investors, so they can see the range that you're using in the weighting for each of your portfolio companies, as well as the weighted average. It also allows them to look at the multiples. You know, have the multiples in the last 2 quarters, you know, for 331 and 630, have they come down? You know, they'll be able to see that here as well. So really leverage the standards and the communications that are already in place. Okay, sorry. So what are investors watching out for? So they're definitely looking to make sure that your valuation changes are directionally correct. This is where exposure charts are really helpful. They're definitely looking at your liquidity and the portfolio company's liquidity. Other factors include, is the carry being unwound? Again, that's very easy for them to see in the PCAP statement, but you want to maybe call their attention to it. Are there any slower defaulting investors? Some side letters have a requirement for the GP to notify the other investors. Sometimes people just pick it up because there is a contribution receivable on the balance sheet. Either way, just make sure what's required of your funds reporting. Another thing that investors are really tuning into is with regards to the performance metrics, total value to paid in. If it's greater than 1, great. If it's less than 1, they take a hard look to see what year is the fund. If it's early on in the fund's life, that's the J curve, that's expected. But if it's later on in the fund's life, and if it's significantly less than 1, investors are going to question whether or not there's an alignment that still exists between the LPs and the GPs. And they're trying to get to a watch list just like you are. So they're developing what data points that are contributing to their watch list or rating, what criteria is part of it. So that's another reason why they're asking for more data from their GPs. So got some great questions on valuations. Again, love this first one. So in the past, privately held company valuations relied on long-term trends and didn't have to sell. Why should we significantly adjust fair market value for 331 or 630? So this is like our industry's history in a nutshell right here. We have always prided ourselves on not being as volatile, but part of it is because maybe we took our foot off the gas on the true fair market value process, which then undermined the trust of the investors, made them question practical expediency, and possibly gave them an allocation problem. So let's not do that again. This, going back to what we talked about, you really do have to take into account everything that is known and knowable as of the valuation date. Obviously, public markets are known and knowable as of the valuation date. So even though you might not consider them orderly, you need to take them into account. Again, you can change the weighting, but you need to document that and make sure it's communicated to investors. But you do have to take it into account. You can't just say markets were crazy, I'm just going to go back to my DCFs. And the next question is, should we view current market multiples given the volatility, trailing 12-month, future 12-month? Again, I myself think in times of dramatic change, future 12 months is the way to go, because you've got to use, current forecasts, but you got to be careful about that double dip. So make sure you're not, again, to the extent you're using future 12 for the DCF, and then maybe, prior 12 to the extent you're using the comps that have already been adjusted for projected changes in performance, that might be a good hybrid. The key with the valuation process is to get as much data in as possible. You don't want to be in a situation where a prospective investor is saying, well, why don't you include this in your valuation process? That's awkward. Communications. Do you do all LPs, just the LPAC, or just wait for the annual meeting? Please don't wait for your annual meeting. You probably just had one. Waiting a year to tell them about valuation processes and updates, not a good idea. And please do try to communicate to all LPs. Again, this gets back to the trying to avoid treating some LPs differently than other with regards to availability of information. Okay, I'm kind of getting tight on time, so this is just something that we pulled from with regards to getting back to that communication effort and how, as an industry, we need to get better at it. Few things scarier than silence. And also a reminder, there's probably folks on your team and definitely at your portfolio companies that have never been through a cycle. So communications, making sure that you're keeping everyone in the know. These are key points for navigating through this current crisis. And then let's talk about fundraising. I mean, it's not directly part of investor transparency, but definitely on our minds. And honestly, the reason why we're talking about this, and it's because we want to bring current investors back and get new investors. So let's talk about fundraising. So as you can tell, we're big fans of gathering data. So we did a poll in April, and while 40% of the poll participants were not in the market, a third said, who were, that were in the market, a third of the polling participants said that their institutional investors were on track, but others were delayed. And PEI just did a poll this past May, and it was funny because it was just like a third said there was no delay, a third said there was a delay, and a third said, thank God I'm not in the market. So this really highlights it all gets down to your investor base. To the extent that you are fundraising to your existing investor base, they're more than happy to take a hard look at you because they know you. They have all your data. That's kind of the best place to be in the current fundraising environment. The second place to be in is fundraising to new investors that have been following you. This gets back to the earlier comment about give them access to pieces of your portal or make sure that they're in your communication link. Get yourself in front of them on an ongoing basis so that they can follow you. To the extent that you are not necessarily a new investor, but a new fund manager, this is a really tough spot certainly for institutional investors. This is something that they will have a real challenge in doing. A lot of investors are, we get this feedback from the placement agents and consultants. A lot of them are really waiting for the 630 audit to be done so that they can reassess their allocations, they can reassess their commitments, their future commitments. This should not surprise anyone. The investors are looking for a reset of terms because they viewed this past 10 years to be very GP friendly. And another thing that they're very concerned about, and if you're in the market, you want to address this, they are very concerned about fund size and time to close. They don't want to be in a situation where you're constantly asking for extensions on the closing of the fund. They feel like they're taking a big risk, making a commitment in this environment, and they don't want people coming in 2 years from now. They don't feel like they would be rewarded for that risk, getting into the fund like that. So they want to make sure that the fund size that you're targeting and the time to close is reasonable. So I put a lot on your plate. We got 8 minutes to talk about where you begin. So you really got to prioritize. And I'll just share with you a prioritization tool that I learned ages ago. Most of you probably already know this. But it's a nice tool to dust off because, again, there's a lot on your plate. You've got to figure out where do you start. So it's the quadrant chart. Okay, so it's two sides. You have effort, so you go from easy to hard, and you have impact, and you go from low to high. And you map all of your projects on that quadrant chart, and you start with the projects that are easy to do and have a high impact. And then you kind of move across to the harder to do, but still a high impact. And that is just a helpful way of, making sure your firm and your team is on board with the priorities. If it's capital activity, you definitely want to, work with the deal teams on the forecast. You want to make sure you find a scalable way to do the capital activity forecast. And you want to almost get it to the point where you can send out updates daily. That should be in the back of your mind. That's how current this needs to be. For investor reporting, leverage the standards. What's out there in a standard that you can then incorporate into your quarterly reporting package and highlight it. Highlight it in the cover letter to your investors so they know you're working towards this. And really, you got to get the firm on board with this momentous change, that this is the future. We've got to get there. For valuations in the past, PE, it's always been a bit of a challenge. We've been decidedly not as readily marking to market, but this has created allocations issues and concern and trust. So we definitely want to get to the point where we are incorporating fair market value, and you've got to make sure that your team is on board with this. So if you had to pick one, we did a poll, another poll. So if you had to pick one, it's definitely came across that other than the people who wanted to go back to bed, it was pretty much evenly split with a slight balance towards upgrading the valuation process. People felt that that was something that was relatively easy to do and could have a high impact. So this brings us to the end of the official part of the webinar. I do have a few moments for questions, if any came in. I certainly want to thank SBIA for this opportunity to speak with you today, and for you to take the time out of your day to join us. And I certainly, again, hope all of you are staying safe and sane during this time. And if you do have any questions, just reach out to SBIA or reach out to me. I'd be happy to help out in any way I can.
Okay, thank you, Ann. You definitely covered a lot of ground today. We appreciate the time and expertise that you shared. I think you've covered all the questions that have come in so far. Thank you for sending your questions in. If you do have any other questions, or if we did not get to a specific question during the webinar, Ann has graciously agreed to address a few in writing. So if you still have questions, please email them to info@sbia.org. But thank you again, Ann, for sharing your insight. A recording of this webinar along with the presentation materials will be shared with SBIA members. If you're not an SBIA member and would like to learn more about joining our organization, please contact my colleague, Alex Frick, at 202-628-5055 or by email membership@sbia.org. Finally, in closing, we ask that you please mark your calendar for our next Lunch and Learn session, which is scheduled for Wednesday, July 1st at 11 a.m. Eastern Time, where we'll cover the PPP Flexibility Act and how it alters PPP loan forgiveness. Thank you again, and we look forward to having you join us soon.
Thank you.
Thank you, Ann.